For decades, investors had a really simple playbook, right? 60% stocks, 40% bonds. But what happens when that playbook just stops working? Well, today we're going to dive into a fascinating paper from Goldman Sachs that asks if machine learning can write a new one for this crazy, unpredictable economy we're in.
Wow. I mean, this quote really gets right to the heart of the problem, doesn't it? The 60/40 portfolio was supposed to be the bedrock of investing for generations. But in 2022, that foundation didn't just crack, it completely shattered. It's pretty clear the old rules are failing, and that's exactly why this kind of research is so important right now.
So, if the old blueprint is failing, where do we even begin to look for a new one? Well, researchers are turning to artificial intelligence, specifically machine learning, to see if it can navigate the sheer complexity of today's markets in a way that, humans and simple models just can't. Okay, so the paper we're digging into is called Dynamic Asset Allocation Using Machine Learning, Seeing the Forest for the Trees. And it's by Christian Muller-Glissman and Andre Ferriot over at Goldman Sachs. And you gotta love that title, Seeing the Forest for the Trees, because it's actually a perfect little hint at the specific AI model they're using.
So what's the core mission here? This isn't about using AI just for the sake of it. The real goal is to build a dynamic framework, one that's alive, one that actively adjusts its investments, to try and beat the old strategy of just buying a 60/40 portfolio and, well, holding on for dear life.
Now, for the really cool part, how does this thing actually work? The best way to think about it is like a weather forecast, but for the economy. Before the model can tell you whether to, say, bring an umbrella, it needs to understand all the atmospheric conditions.
The first major input is what they call a growth score. This is basically the model's way of checking the vital signs of the economy. It's looking at things like employment numbers, industrial output, and a bunch of other data to figure out, are we growing, are we slowing down, or are we in a recession? Next up, the AI needs to get a read on inflation. So the inflation score pulls in everything from the official consumer price index, the CPI, to real-time commodity prices. This gives it a really complete picture of just how much price pressure is out there. And the third piece of this puzzle is the policy score. You absolutely cannot invest today without paying attention to the central banks. This score tracks what the Federal Reserve is up to. Are they hiking rates? Are they cutting? Are they doing QE? It's an absolutely crucial variable. And finally, the fourth input as that human element. This is a custom risk appetite indicator, and it measures market sentiment. It looks at market data to figure out if investors are feeling greedy and taking on risk, or if they're feeling fearful and running for safety. So the model has both hard economic data and a sense of the market's mood. So what does the model do with all this awesome data? It feeds it into a type of machine learning algorithm called a random forest. Now remember the paper's title, Seeing the Forest for the Trees. That's the perfect analogy. A single decision tree by itself might be flawed. But a forest of thousands of them, all looking at the problem from slightly different angles, well, that can make an incredibly robust and accurate prediction. Now, a full random forest is way too complicated to visualize, but the paper gives us this simplified student tree to let us peek under the hood. Look at how it just asks a series of simple yes or no questions based on those economic scores. Like, is the growth score below this number? And by following the branches, it ultimately forecasts whether the 60/40 portfolio is likely to have a positive or a negative return. And of course, any model is only as good as its data. The authors use top-tier sources. We're talking Bloomberg, Haver Analytics, you name it. And what's really crucial here, their data goes all the way back to 1950. That gives the AI more than 70 years of really diverse economic cycles to learn from. Okay, so the model takes in all this data. It makes a forecast, but a forecast is pretty useless if you don't actually do something with it. So how does this all translate into a real-world investment strategy? Well, the paper proposes 3 specific dynamic actions, or overlays, that the AI can trigger. First, if the model predicts a really high chance of a big loss, it can just move the portfolio into the safety of cash. Second, it can actively rotate between stocks and bonds, putting more weight on whichever one the model likes better. And third, it can add commodities or gold to the mix, especially when the model is flagging high inflation risks. This chart right here shows you what dynamic actually looks like in practice. The different colors are stocks, bonds, and cash. Just look at how the allocations are constantly shifting over the years. This is the absolute opposite of a static, set it and forget it strategy. The AI is always on the move, always adjusting based on its forecast.
This all sounds pretty great in theory, but here comes the billion-dollar question. Did it actually work? Let's take a look at the results and see if this AI-driven approach really delivered on its promise.
And here it is. This chart is basically the money shot. It shows the cumulative return of $1 invested back in 1950. That bottom line? That's your traditional 60/40 portfolio. The lines above it are the various dynamic AI-driven strategies, and I mean, over the long run, the outperformance is huge.
The paper's own conclusions totally back up what that chart shows. The AI didn't just improve the raw returns, it improved the risk-adjusted returns, so it generated better performance for the amount of risk it was taking. And crucially, the results held up in out-of-sample tests, meaning it worked even on data that it had never seen before during its training.
I think this final quote is so key. A really common fear with AI is the black box problem, right? The idea that you can't understand its reasoning, but the authors stress that this model is supervised. Humans control the inputs and they interpret the outputs. It's an intelligent tool, not some magic oracle. And this allows it to capture these complex, non-linear relationships in the data that are just not a simple straight line.
Which brings us to our final question. This research really shows what's possible when you combine decades of market data with powerful machine learning. It's probably not about replacing human managers tomorrow, but it definitely makes you wonder, as these tools get even better and even smarter, will the next great portfolio manager actually be an algorithm? Something to think about. Thanks for tuning in.